We're watching something unusual unfold in the precious metals market right now. Silver and gold just fell together in coordinated selling pressure, and yet some of the world's most vocal precious metals advocates are doubling down on their long-term bullish stance. Robert Kiyosaki, author of Rich Dad, Poor Dad, and longtime gold and silver investor, just went on record predicting silver could hit $200 per ounce in the coming years. But here's what makes this moment critical. This drop isn't happening in isolation. Market signals suggest we're watching institutional repositioning, physical demand pressure building in the East, and a disconnect growing between paper and physical markets. The next few weeks could define the silver narrative for the rest of 2026. If you're tracking precious metals, following global monetary policy, or trying to understand what's really happening behind these price swings, hit that subscribe button and turn on notifications. This channel breaks down the data, the patterns, and the pressure points most commentary overlooks. Let's break down what just happened, why it matters, and what scenarios could unfold from here. Here's what we witnessed over the past 72 hours. Silver dropped from around $31.50 per ounce to approximately $29.80, a decline of roughly 5.4% in a matter of days. Gold moved in tandem, falling from near $2,680 down to around $2,620. Both metals sold off together, which immediately caught the attention of traders and analysts watching these markets closely. Now, coordinated drops like this don't happen by accident. Market data indicates this was driven primarily by futures market selling, large position liquidations hitting the COMEX exchange during overnight trading sessions when liquidity is thinner. The selling pressure came in waves, first during Asian trading hours, then accelerating during early European hours before New York opened. Volume spiked significantly. Silver futures volume was running 30 to 40% above average during the sell-off period. That tells us this wasn't retail panic. This was institutional-sized money moving out of positions, likely triggered by stop-loss orders cascading as technical support levels broke. The US dollar index strengthened modestly during the same window, rising from 108.2 to 109.1. When the dollar gains strength, commodities priced in dollars typically face headwinds. Investors saw this dollar bounce and took it as a signal to reduce precious metals exposure in the short term. But here's where the story gets more interesting. While paper prices fell, reports from physical dealers indicated something different was happening on the ground. Premiums on physical silver coins and bars held steady or increased slightly in several markets. Delivery delays didn't improve. They stayed elevated. This divergence between paper price action and physical market conditions is exactly the kind of signal that historically precedes major moves in silver. The sell-off also coincided with Treasury yields pushing higher. The 10-year Treasury yield climbed back above 4.7%, making bonds relatively more attractive compared to non-yielding assets like silver and gold. Capital flows respond to these yield shifts, and we saw money rotating out of metals and into fixed income instruments as rates ticked up. So why are sophisticated investors, including figures like Robert Kiyosaki, looking at this drop and seeing opportunity rather than concern? Several pressure points are building beneath the surface of these price moves. First, the futures versus physical demand disconnect. The COMEX silver inventory, the actual physical silver sitting in approved warehouses backing futures contracts, has been fluctuating between 290 and 320 million ounces over recent months. Meanwhile, global silver demand from industrial applications, solar panels, electronics, and investment has been running at approximately 1.2 billion ounces annually. Recent data indicates industrial demand alone consumed around 690 million ounces last year, with solar panel manufacturing accounting for nearly 200 million ounces of that total. That means the entire COMEX inventory represents roughly 25 to 27% of annual global demand. When you consider that most of that inventory is already spoken for, allocated to specific contracts and owners, the amount of truly available physical silver for immediate delivery becomes much smaller. Investors are watching this ratio closely. If delivery demand increases even modestly against futures contracts, the exchange faces pressure to either source additional physical metal or allow cash settlements instead of physical delivery. Historically, when this pressure builds, physical premiums rise and price volatility increases. Second, inventory versus delivery requirements. Each futures contract on the COMEX represents 5,000 ounces of silver. Currently, open interest, the total number of outstanding contracts, sits near 150,000 contracts. If even a small percentage of those contract holders decided to stand for delivery instead of rolling their positions forward or settling in cash, we're talking about potential delivery obligations in the tens of millions of ounces within a single delivery month. The January delivery period just passed with moderate delivery activity, but March and May are typically higher activity months. Market participants are watching whether delivery demands tick higher as physical buyers in Asia and the Middle East continue accumulating metal. Third, global demand trends showing persistent strength. China's silver imports have remained elevated despite higher prices earlier this year. Recent trade data shows China imported approximately 4,800 metric tons of silver in November and December combined. That's roughly 154 million ounces over just 2 months. India's demand for silver, both for industrial use and cultural purposes, continues running at historically high levels. Meanwhile, mine supply growth remains constrained. Primary silver mines, those mining specifically for silver rather than producing it as a byproduct, represent only about 25% of global supply. The rest comes from mines primarily focused on copper, lead, zinc, and gold. When those base metal prices soften or mining operations face cost pressures, silver supply as a byproduct can decline unexpectedly. This sets up a fundamental dynamic, demand staying strong or growing, while supply faces structural limitations. That's the kind of setup that creates asymmetric risk-reward profiles, more potential upside than downside over intermediate time horizons. Fourth, the monetary policy backdrop. Central banks globally have been in an unusual position. Despite higher interest rates in the US and parts of Europe, inflation hasn't fully normalized to target levels. Core inflation measures remain above the 2% targets most central banks target. At the same time, economic growth signals are mixed, some sectors showing strength while others demonstrate weakness. This creates uncertainty about the future path of interest rates. If rates stay elevated longer, that typically pressures non-yielding assets like silver in the short term. But if inflation reaccelerates or central banks are forced to cut rates faster than currently projected, precious metals historically benefit as hedges against currency devaluation and monetary instability. Investors are positioning for both scenarios, which explains some of the volatility we're seeing. Short-term traders react to immediate rate signals, while longer-term investors accumulate physical metal based on multi-year monetary trends. Let's put some specific numbers into context to understand what's really happening. Current price versus historical ranges. Silver is currently trading around $29-30 per ounce. Compare that to the 2011 peak of approximately $49. The 2020 surge to around $29.30. Similar to now. The 2022-2023 range, mostly between $18.26, the early 2024 breakout above $30, followed by consolidation. We're essentially at the upper end of the 5-year range, but well below the levels reached during previous precious metals bull markets. The inflation-adjusted all-time high for silver, reached in 1980, would translate to approximately $140 or $150 per ounce in today's dollars. That gives context to predictions like Kiyosaki's $200 silver call. It's above the nominal all-time high of 49, but within the realm of possibility if adjusted for currency devaluation over the past 45 years. Gold-silver ratio dynamics. The gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, currently sits near 88:1. Gold at 2,620 divided by silver at 29.80 equals roughly 88. Historical context matters here. The ratio averaged around 60.1 through much of the 20th century. During the 2011 precious metals peak, the ratio briefly touched 30.1. In early 2020, the ratio spiked to 125.1 before compressing rapidly. Over the past century, the ratio has typically ranged between 40.1 and 80.1. At 88.1, silver is relatively cheap compared to gold by historical standards. If the ratio reverted to 60:1, while gold held current levels, silver would trade around $43 to $44 per ounce. If gold rose to $3,000 and the ratio compressed to 50.1, silver would reach 60. These are not predictions. They are mathematical scenarios showing what ekes possible if historical patterns repeat. East versus West market dynamics. Shanghai gold exchange prices have occasionally traded at premiums to London and New York prices over the past year. When physical metal commands higher prices in Asian markets than Western paper markets, it signals strong physical demand pulling metal eastward. Silver flows have followed similar patterns. Chinese Silver Group data indicates domestic silver consumption has been outpacing domestic production by 30-40% annually, requiring substantial imports to meet demand. India's industrial and investment demand adds another major demand center that competes for global supply. Meanwhile, Western investment demand measured through ETF holdings has been more volatile, seeing both inflows and outflows as traders react to short-term price moves and rate changes. But the underlying physical demand from industrial and commercial applications in Asia continues absorbing significant quantities regardless of short-term price fluctuations. Supply versus demand fundamentals. The Silver Institute. As data suggests global silver demand has exceeded mine supply by varying amounts in recent years, with above-ground stockpiles and recycling filling the gap. Total silver demand for 2024 is estimated around 1.2 billion ounces, while mine production contributed roughly 850 million ounces. The 400 million ounce deficit is covered by recycling, approximately 180 million ounces, and drawdowns from above ground inventories. But here's the critical point. Above ground inventories aren't infinite, and a significant portion exists in forms not easily mobilized for industrial use: silverware, jewelry, art objects, and inaccessible stockpiles. The portion of inventory that's truly available, exchange-traded holdings, government stockpiles, and dealer inventories, is much smaller than the total above-ground stock. Estimates of easily accessible inventory range from 1.5 to 2.5 billion ounces globally. At current demand rates, that represents 15 to 25 months of supply without any mine production. That's not an immediate crisis, but it does mean sustained deficits over several years would meaningfully tighten available supply, potentially setting up price pressures if demand remains strong. Given these dynamics, what scenarios could unfold over the next 3 to 6 months? Scenario 1, consolidation and base building. In this scenario, silver continues trading in a range between $28.33 per ounce through spring 2026. The recent sell-off finds support near current levels and the market enters a consolidation phase. If this unfolds, we'd likely see physical demand remaining steady but not accelerating dramatically, futures market activity stabilizing with open interest, fluctuating in normal ranges, modest premium levels on physical products, present but not extreme, industrial buyers purchasing on dips to secure supply for manufacturing needs. This scenario would represent market equilibrium, with buyers and sellers roughly balanced. It wouldn't be dramatic, but it would allow investors focused on longer-term fundamentals to continue accumulating metal at relatively stable prices. Historical precedent shows silver often consolidates for months before making decisive moves, the 2023 early 2024 period being a recent example. The catalyst for breaking out of this range could come from either a shift in monetary policy expectations or a surprise on the physical demand side. Perhaps a major industrial buyer announcing expanded silver-intensive production plans, or an ETF seeing sudden large inflows. Scenario 2, further downside testing. In this scenario, silver tests lower support levels, potentially dropping toward $27 to $28 or even $25 if selling pressure intensifies. This could happen if the US dollar continues strengthening on rate expectations. Treasury yields push higher, pulling capital toward fixed income. Economic data softens, reducing industrial demand expectations. Large speculative long positions continue liquidating. The key question in this scenario: does physical demand provide a floor? History suggests physical buyers become increasingly aggressive as prices decline below production costs for primary silver miners. With all-in sustaining costs for silver miners estimated around $20.25 per ounce, prices below that range typically trigger supply responses, mines reducing production or physical buyers stepping in more aggressively. If silver did test $25.27, that would likely represent an attractive entry point for investors with longer time horizons, assuming the fundamental demand story remains intact. The 2023 lows near 21 order to the 22 order provided exactly that kind of opportunity before the subsequent rally into 2024. Scenario 3, reversal and renewed rally. In this scenario, the recent sell-off represents a temporary correction before silver resumes its upward trajectory. This could unfold if physical delivery demand increases against futures contracts, tightening available supply. Industrial demand data releases show stronger than expected consumption. Central bank policy shifts toward more accommodative stances. Geopolitical tensions or monetary instability increase safe haven demand. Technical buying emerges as the market reclaims key resistance levels around $32. In this case, silver could retest the $34.35 range reached in late 2024 within weeks or months. Beyond that level, for silver to reach prices in the $40.50 plus range that bulls like Kiyosaki anticipate, multiple factors would likely need to align. Persistent supply deficits, strong investment demand returning to Western markets, industrial demand remaining robust, and some combination of inflationary pressure or currency concerns driving safe haven flows. Kiyosaki's specific prediction of $200 silver represents an extreme bull case, roughly 6 to minus Sinowankadik's current levels. For context, that would require either severe monetary instability, a dramatic supply shortage, or both. It's possible over a multi-year time frame if multiple tail risk scenarios materialized, but it would represent a historic move that exceeded even the 1980 and 2011 peaks in real terms. Why are the next few weeks and months particularly important for silver? First, delivery month dynamics. March is historically a more active delivery month on the COMEX than January. As we move through February and into March, watch for delivery notices and whether the exchange sees elevated delivery demands. If delivery activity picks up noticeably, it could indicate physical buyers are increasingly preferring to take metal off the exchange rather than rolling positions forward. Second, seasonal industrial demand patterns. Spring typically sees increased industrial activity as manufacturing ramps up after winter slowdowns in some sectors. If economic data through February and March shows industrial production expanding, that could support silver demand fundamentals. Conversely, if manufacturing data disappoints, it could weigh on near-term sentiment. Third, monetary policy decision points. The Federal Reserve meets in March and May, with markets currently divided on whether any rate cuts materialize in the first half of 2026. The European Central Bank and other major central banks have their own policy meetings over the same period. If the policy tone shifts more dovish than currently priced in, or if inflation data surprises to the upside, that could trigger renewed interest in precious metals. Fourth, physical market indicators. Watch for premium levels on coins and bars from major dealers, delivery times quoted by physical sellers, Shanghai prices relative to London and New York ETF flow data from major silver funds like SLV. If physical premiums rise noticeably, delivery times extend, or Asian prices show persistent premiums, those are signals that physical tightness is building even if paper prices remain subdued. Fifth, technical positioning. The futures market. Commitment of traders reports show commercial hedgers and large speculators' positions. Recent data indicates managed money has reduced long positions, which often marks capitulation periods that precede rallies. If commercial hedgers, typically miners and producers, start reducing their short hedges, it can signal they expect higher prices ahead. Historical precedent matters here. Previous corrections in silver during 2020 and 2023 created multi-month buying opportunities before significant rallies followed. The 2020 drop to 12 was followed by a rally to 29. The 2022 bottom around 18 preceded the 2024 move above 30. The question facing investors now, is this drop a similar opportunity, or is it the start of a deeper correction? The data suggests we're at an inflection point. The fundamentals, supply deficits, strong physical demand, monetary uncertainty, support a bullish, longer-term case. But the near-term technicals and positioning suggest volatility could continue as the market works through this correction phase. So here's what we're watching. Silver just experienced a coordinated sell-off with gold, dropping from $31.50 to around $29.80 in a matter of days. Paper market selling pressure drove the move, triggered by dollar strength, rising yields, and technical stop-loss cascades. But beneath that surface action, the fundamental picture remains compelling. Global demand running approximately 400 million ounces above mine supply annually. Industrial applications, particularly solar and electronics, showing structural growth. Eastern markets continuing to import substantial quantities. Exchange inventories representing a relatively small percentage of annual demand. Historical price ratios suggesting silver remains undervalued relative to gold. Meanwhile, prominent precious metals investors like Robert Kiyosaki are looking at this exact setup and predicting silver could reach $200 per ounce in the years ahead. That prediction might sound extreme, but it's based on a thesis about monetary instability, supply constraints, and historical precedent during previous precious metals bull markets. Whether silver reaches $50, $100, or $200 depends on variables we can't predict with certainty. The path of interest rates, the severity of supply deficits, the strength of investment demand, and the stability of global monetary systems. What we can say, the market is sending mixed signals right now. Paper prices fell sharply while physical indicators remained firm. That divergence is historically significant. It suggests the institutions trading futures contracts have different perspectives than the buyers taking physical delivery. The scenarios ahead range from further consolidation around current levels to deeper corrections testing support near 25-27 to renewed rallies potentially challenging recent highs and beyond. Each scenario depends on different factors playing out: dollar direction, physical market tightness, policy shifts, and demand trends. For investors and observers, these next few months provide clarity. The market will show us whether this sell-off marks a temporary pause in an ongoing bull trend, or whether deeper corrections lie ahead. Physical market indicators, premiums, delivery times, Asian price action will provide early signals about which direction the market is heading. This is why staying informed matters. The precious metals market doesn't move in straight lines. It tests, corrects, consolidates, and occasionally explodes higher when conditions align. Understanding the signals, the data, and the pressure points helps you navigate the volatility and identify the moments that matter. If you found this analysis valuable, hit that like button. It helps this content reach others tracking these markets. Share Share this video with anyone who's asking questions about silver's volatility or wondering what Kiyosaki's prediction really means. And subscribe with notifications on, because we're tracking this situation week by week as it develops. The next update could be the one that marks the turning point. The silver market is being closely watched for good reason. What happens next could define the precious metals narrative for years to come. Stay informed, stay focused, and we'll see you in the next analysis.